The United States Senate is preparing to formally vote on Bitcoin's legal future this month. Not sometime, not eventually, this month. The Clarity Act, the most consequential piece of digital asset legislation in American history, is headed for a Senate Banking Committee markup in May of 2026. And if you have a savings account, a retirement fund, or any amount of money sitting in any financial institution right now, what happens next in that committee room is something you should understand before it happens. This video is going to explain exactly what this legislation is, what it would do, and what it means, in plain language, for your financial life. Bitcoin closed today at $81,286. That is its strongest close since January. And if that number is all you take from today's headline, you are missing the part that actually matters. Because the real story is not what Bitcoin's price did today. The real story is what the United States Senate is about to do, and what it means for the money you have worked your entire life to protect. Stay with me for the next few minutes, because what is happening right now in Washington is something that will look very different in hindsight than it looks on the surface. Today's 2.93% gain, $2,311 added to Bitcoin's price in a single 24-hour session, is notable. But price moves happen every day. What does not happen every day is the simultaneous convergence of three independent and very large forces around a single asset in ways that have no clear precedent. Understanding what those three forces are and why they are arriving at the same moment is the actual task of today's video. The first force is legislative. The United States Senate is preparing to formally mark up the Clarity Act, bipartisan legislation that would establish the first comprehensive federal legal framework for digital assets in American history. The word markup in legislative terms means a committee is about to sit down, go line by line through the bill, finalize its language, and vote on whether to send it to the full Senate floor for a vote. That is not the beginning of a process. That is the end of one. This particular bill already cleared the entire United States House of Representatives. It passed the House more than 8 months ago. It has been sitting in the Senate since then. The markup session is expected this month, May of 2026. That is a specific, documented, imminent development. The second force is institutional. US-listed spot Bitcoin exchange-traded funds, investment products that allow everyday investors to own Bitcoin exposure through a standard brokerage account, have recorded 3 consecutive days of net inflows. In the past 24 hours alone, those funds pulled in $532 million. Over the past 2 months, the figure is $3.29 billion. Simultaneously, according to flow data from Bank of America Global Research and EPFR cited by Reuters, institutional investors removed $4.5 billion from gold in a single week and directed $1 billion directly into crypto. These are not individual investors acting on gut feeling. These are professional asset managers making deliberate, documented decisions about where large pools of capital should be positioned. The third force is macroeconomic. Multiple major banks formally abandoned their Federal Reserve interest rate cut forecasts as of today. The Federal Reserve, the central bank of the United States, the institution that sets the benchmark interest rate that flows through every mortgage, every savings account, every credit card in America, was widely expected by banks and economists to cut rates at some point in 2026. Those forecasts have now been retracted. Rates are staying higher for longer. On the same day that news landed, Bitcoin moved upward. That divergence is not coincidental, and we will come back to exactly what it means. These three forces, legislative recognition, institutional capital rotation, and macroeconomic pressure, are not happening in isolation. They are happening at the same time, in the same week, pointing in the same direction. That pattern is what demands serious attention today. To understand why the legislative piece matters so much, it helps to think about what happens historically when the U.S. government moves to formally recognize a major asset class. When federal regulatory clarity arrives for any financial instrument, something specific happens. It eliminates the one risk that large institutional investors fear more than price volatility. It eliminates legal uncertainty. When the rules of engagement become defined, capital that had been sitting on the sidelines, waiting for clarity before committing, begins to move. The money does not rush in all at once, it begins to migrate, and that migration tends to be structural rather than speculative. Consider what the ETF flow data tells us about how that process works in real time. US-listed spot Bitcoin exchange-traded funds launched in January of 2024. Since their launch, cumulative net inflows have reached $58.72 billion. The peak was $61.19 billion, reached in October of 2025. Then, Bitcoin's price declined from over $100,000 to near $60,000 between November of 2025 and February of 2026, and investors withdrew $6.38 billion from those same funds over that 4-month stretch. That is a real and painful data point. But what followed? The capital started returning. $3.29 billion over the past 2 months. $532 million in the past 24 hours. The recovery is real, though it is also incomplete. The gap between the $58.72 billion current figure and the $61.19 billion peak represents the ground that still needs to be made up. That gap is worth keeping in mind. The world's largest asset manager, BlackRock, now holds $63.7 billion in its single-spot Bitcoin exchange-traded fund. One fund. $63.7 billion. That is not a speculative position. That is a structural allocation, a long-term institutional decision about Bitcoin's role in a diversified portfolio. It represents a demand floor, a base level of capital that is not responding to daily price movements, but to a strategic view about what this asset class is becoming over years, not weeks. Now here is the part of this story that most Bitcoin coverage skips entirely. Because the three forces we just described do not exist in a vacuum. They exist inside a specific economic moment that is affecting your financial life right now, whether or not you own a single dollar of Bitcoin. If you have a savings account, you have probably noticed that the interest rate on that account does not keep pace with what you actually spend every month. That is not your imagination. It is a documented reality of the current interest rate environment. And today's news, that major banks have now abandoned their forecasts for Federal Reserve rate cuts, means that reality is not changing anytime soon. Rates are staying elevated. For someone carrying a mortgage, that matters. For someone whose savings account rate is still running behind actual inflation, that matters. For someone whose retirement account has significant exposure to bonds, which tend to lose value when interest rates remain high, that matters directly and measurably. The traditional response to this situation, the playbook that financial advisors have recommended for decades, has centered on one asset above all others as a store of value against dollar erosion: gold. When central banks expand money supplies, when currencies lose purchasing power, when political uncertainty clouds the economic horizon, the conventional protection has been gold. 2,000 years of history as a monetary asset, physically real, genuinely scarce. Those properties are not changing. Gold still works. But something else is documented in this week's flow data, and it deserves to be stated plainly. According to the data from Bank of America Global Research and EPFR cited by Reuters, in a single week, institutional investors, the managers of pension funds, university endowments, and large family offices, pulled $4.5 billion out of gold and directed $1 billion of it into crypto. They did not do this because they are enthusiastic about Bitcoin. They did this because their portfolio mathematics is telling them something different than it told them 5 years ago. Portfolio mathematics right now is beginning to favor a digital asset with a provably fixed supply. Bitcoin will never have more than 21 million units in existence, ever, over a physical commodity that can be mined in larger quantities as technology improves. That is not a narrative. That is a structural comparison being run by professionals who are paid to be right about it. For the average American who has spent years watching financial institutions make decisions that seem to have nothing to do with their interests, this is a data point worth sitting with. The institutions are not persuaded by enthusiasm. They are moved by numbers. And right now, the numbers are moving them in a specific direction. That context is the frame through which the dominant story of today must be understood. Because what is happening in the Senate this month is not just an industry event. It is the formal beginning of Bitcoin's integration into the permanent financial architecture of the United States. The Clarity Act, which stands for the Digital Asset Market Structure and Investor Protection Act, is bipartisan legislation that would accomplish something that sounds simple but has proven extraordinarily difficult to achieve. It would define, for the first time at the federal level, exactly which digital assets are commodities, which are securities, which federal agency governs each category, and what the rules of that governance are. None of those questions currently have definitive answers in American law. To understand why that matters, it helps to understand the two agencies involved. The Commodity Futures Trading Commission, the federal agency that regulates commodity and derivatives markets, including oil, gold, and agricultural futures, has argued for years that many cryptocurrencies, including Bitcoin, fall under its jurisdiction as commodities. The Securities and Exchange Commission, the federal agency that regulates stocks, bonds, and investment products, has argued that many cryptocurrencies are securities and therefore fall under its authority. These two agencies have been in a jurisdictional dispute over digital assets for the better part of a decade. That dispute has not been resolved in court. It has not been resolved by Congress. It has existed as a persistent cloud of legal uncertainty that has made it difficult for banks, investment firms, and financial institutions to fully engage with digital assets without risking regulatory action. The Clarity Act resolves it. The bill draws a clear and specific line. Certain digital assets fall under the CFTC and are regulated as commodities. Others fall under the SEC and are regulated as securities. Bitcoin, under the current structure of the bill, would be classified as a commodity. That classification carries practical weight. Commodities regulation in the United States is generally less restrictive than securities regulation, which means that a Bitcoin designated as a commodity faces fewer legal obstacles to being held, traded, transferred, and offered to investors across different account types and platforms. Senator Cynthia Lummis of Wyoming has been among the most consistent and vocal advocates for this legislation, and according to reporting from Cointelegraph this week, corroborated by CoinDesk, CryptoSlate, and CoinMarketCap, she is pressing the Senate to move quickly. The Senate Banking Committee is expected to hold that formal markup session during May of 2026. The timing of that movement appears to have been unlocked by a parallel development, a breakthrough in Senate negotiations over stablecoin regulation. A stablecoin, for those who have not encountered the term, is a digital currency designed to maintain a stable value, typically pegged one-to-one with the US dollar. Think of it as a digital dollar token. The dispute in the Senate over stablecoin regulation had created a logjam that was slowing the broader Clarity Act. The specific sticking point was whether stablecoins should be permitted to pay interest to holders, a question with significant implications for banks and money market funds, which compete with any interest-paying dollar-denominated product. According to reporting from CoinDesk and CryptoSlate, that sticking point has been resolved through a compromise, and when that resolution landed, it opened the legislative path for the Clarity Act to move forward. The market responded immediately. Shares of Circle, one of the largest stablecoin issuers in the United States, and Coinbase, the largest U.S.-regulated cryptocurrency exchange, both rallied sharply on May 5th, as investors began pricing in the increased probability of this legislation advancing. Running alongside the Clarity Act, but distinct from it, is a second development that deserves its own careful explanation: the U.S. Strategic Bitcoin Reserve. At the Bitcoin 2026 conference on April 28th, 1 week ago, a White House advisor named Patrick Witt publicly referenced a big announcement on the Strategic Bitcoin Reserve that he said would arrive within the next few weeks. Draft legislation currently circulating in Washington, called the American Reserves Modernization Act, or ARMA, proposes that the United States government formally accumulate up to 1 million Bitcoin as a designated strategic national asset. The US government already holds Bitcoin. Substantial quantities have been seized over the years through drug trafficking prosecutions, cybercrime cases, and financial fraud investigations. What ARMA would do is establish a legal and operational framework for treating that Bitcoin not as evidence to be liquidated and returned to the Treasury as dollars, but as a strategic reserve, an asset to be held deliberately, in the way the United States holds its strategic petroleum reserve as a buffer against oil supply shocks. 1 million Bitcoin. There will only ever be 21 million Bitcoin in existence. That limit is written permanently into Bitcoin's code and cannot be altered by any government, company, or individual. If the United States were to accumulate 1 million Bitcoin, it would hold approximately 4.76% of the total Bitcoin supply that will ever exist. No official announcement has been made as of today, but a White House advisor speaking publicly about it at a major conference with a specific timeline attached is a categorically different order of signal than anything that has come from Washington on this subject before. Now, alongside this legislative and institutional momentum, the complete picture requires addressing what the data also shows on the cautionary side. Because this is not a simple story with one direction. There are real and documented headwinds in today's data, and they deserve the same clear explanation as everything else. Analyst Ali Martinez published a note this week raising a concern about the structural strength of this rally. His data point, stablecoin reserves held on cryptocurrency exchanges dropped 5.18% in a single week, falling from $70.37 billion to $66.37 billion. Stablecoins sitting on exchanges are generally understood as a proxy for available buying power, capital positioned and ready to deploy into assets like Bitcoin. When that reserve falls sharply, it can indicate that money is leaving the crypto ecosystem rather than rotating within it. If that interpretation is correct, the current price recovery is happening with less purchasing fuel behind it than the price level alone would suggest. That is worth monitoring carefully in the days ahead. On-chain data from Glassnode, the on-chain analytics firm that tracks actual activity recorded on the Bitcoin blockchain, adds further texture. Their data shows that 60% of all Bitcoin currently in circulation is profitable at today's price levels. That is meaningful context. It also means that 40% of all Bitcoin holders, a very large number of people, are still holding coins purchased at prices higher than where Bitcoin trades today. Those investors are not in a position to sell at a gain. When Bitcoin eventually reaches the price at which they bought, some portion of them will sell. That potential overhead selling pressure is real, documented, and relevant to understanding what Bitcoin's path higher may look like from here. Glassnode also identified what they describe as a supply air gap between $72,000 and $82,000. The concept of a supply air gap refers to a price range where very few Bitcoin transactions historically occurred, which means there is limited on-chain resistance in that zone. Price can move through it relatively quickly in either direction. Bitcoin is currently sitting near the top of that range at $81,000. Whether it breaks above $82,000 and enters genuinely new price territory or pulls back toward the lower end of the zone is a question the on-chain data does not yet answer. Both outcomes are consistent with the current picture. The short-term holder cost basis, the average price at which investors who bought Bitcoin within the past 155 days currently stand, sits at $79,000. Bitcoin is trading above that level today, which means recent buyers are marginally profitable on paper. But Glassnode's data also shows that as Bitcoin approached $79,000 in recent sessions, the rate at which short-term holders were realizing profits accelerated, from $1 million per hour to $4 million per hour. That acceleration tells you something real. Investors who have been holding at a loss for months, watching and waiting, tend to sell when they finally see their position turn green. That selling pressure is not theoretical. It is documented on the blockchain, and it is one of the forces Bitcoin is navigating in real time as it works to hold above $80,000. Then there is the strategy data point, and this one requires precise handling because it is easy to misread in both directions. Strategy. Formerly known as MicroStrategy, now operating under its rebranded name, is the largest corporate holder of Bitcoin in the world. As of today, the company holds 762,099 Bitcoin on its corporate balance sheet. That is a position worth roughly $61.9 billion at today's price. In the first quarter of 2026, Strategy reported a net loss of $12.54 billion. That loss was the direct consequence of Bitcoin's price declining from approximately $87,000 at the start of the year to $68,000 by the end of March, a decline of roughly 22% over 90 days. Here is the important distinction. That $12.54 billion figure is an accounting loss, not a cash loss. Under current accounting rules, companies that hold Bitcoin on their balance sheet are required to mark the value of those holdings to the current market price at the end of each reporting period. When the price falls, they record a loss. When the price recovers, they record a gain. Strategy has not sold its Bitcoin. No cash left the company as a result of this loss. But it is also a genuine illustration of what a 22% price decline over 3 months looks like at the scale of a major corporate position. Anyone holding Bitcoin, whether in a personal account, a corporate treasury, or a retirement fund that has Bitcoin exposure, is accepting the possibility of that kind of move in any given quarter. That is not a reason to avoid the asset. It is a reason to understand it clearly before deciding how much of your financial life you want exposed to it. The geopolitical dimension of this week adds one more data point worth naming. On Monday, May 4th, Bitcoin surged to $80,594, its highest level since January 31st. Within hours of that move, reports emerged of a suspected Iranian missile strike near a U.S. patrol boat close to Jask Island in the Strait of Hormuz. Bitcoin reversed $1,520 in a single session, dropping to $79,074. The U.S. government subsequently denied that any vessels were struck. Oil and equity futures spiked and then paired their moves. Bitcoin partially recovered. But the episode demonstrates something specific. Bitcoin's status as a politically neutral, decentralized asset does not make it immune to macro shock events. When geopolitical uncertainty spikes sharply, large investors reduce risk across their portfolios. And in moments of maximum uncertainty, Bitcoin is still treated as a risk asset by many of them, not as a safe haven. That distinction matters for how you think about what role this asset plays. Now let's step back from the data and be clear about what is actually confirmed as of today, May 5th of 2026. What is confirmed? Bitcoin closed at its strongest level since January. U.S. spot Bitcoin exchange-traded funds recorded $532 million in net inflows today, the third consecutive positive day, with $3.29 billion recovered over the past 2 months, against a prior outflow of $6.38 billion. The Clarity Act is moving toward a Senate Banking Committee markup this month, the most significant advancement of digital asset legislation in American history. A White House advisor referenced a major strategic Bitcoin reserve announcement in specific terms with a specific timeline. Institutional investors pulled $4.5 billion out of gold and put $1 billion into crypto in a single week. Multiple major banks retracted their Federal Reserve rate cut forecasts on the same day Bitcoin moved higher. What is also confirmed, stablecoin reserves on exchanges dropped more than 5% in 1 week, a potential signal of reduced buying pressure. 40% of Bitcoin's circulating supply remains unprofitable at current price levels. The world's largest corporate Bitcoin holder reported a $12.54 billion accounting loss from a 22% quarterly drawdown. Bitcoin dropped $1,500 in a matter of hours on a single geopolitical headline that was later disputed. The recovery in ETF inflows has not yet closed the gap left by $6.38 billion in prior outflows. Both pictures are true at the same time. That is the honest, complete view of where this asset sits on this particular day. There is a question that tends to sit quietly in the back of anyone's mind when they watch a market move like this one. The question is simple. Am I too late? It is worth addressing directly because it deserves a direct answer rather than a dismissive one. The data available today does not resolve that question, and anyone who tells you with certainty that you are too late or that you are not too late is working from opinion rather than from evidence. What the data does show is this: 60% of Bitcoin's circulating supply is currently profitable at today's price. That means 40% of all Bitcoin holders in the world, a significant proportion, bought at prices above where it trades right now. Those are not people who got in at the beginning. They are people who entered at various points during the most recent cycle and have been waiting for recovery. The question of whether a price point is early or late is always relative to where an asset eventually trades, and that destination for Bitcoin is genuinely not known. What is known is the legislative direction, the institutional direction, and the macroeconomic pressure that today's data documents in real terms. Knowing those three things clearly, understanding what is driving them, who the participants are, and what the data actually shows, is a form of preparation that is separate from any purchase decision. And that preparation, right now, is something very few people around you actually have. The story that begins with this month's Senate Banking Committee markup is not going to resolve in a single session. If the Clarity Act advances out of committee, it moves to the full Senate floor. If it passes the full Senate, it goes to the president's desk. Each of those steps will generate news, debate, setbacks, and forward movement over the coming weeks. The Strategic Bitcoin Reserve announcement, if it arrives on the timeline Patrick Witt described, will generate its own round of reaction that needs context to interpret correctly. The ETF flow data will update every day. The on-chain signals from Glassnode will shift as price moves. Understanding what each of those developments actually means, having the framework to interpret them correctly as they arrive, is what separates an informed observer from someone reacting to headlines. If this channel's work has helped you build that framework today, then consider staying connected, because this story has chapters still to come, and each of them will require the same kind of grounded, factual interpretation that we have applied here. The next several weeks are going to produce signals worth watching closely, and knowing what you are looking at when those signals arrive makes a real difference in how you respond to them. Here is where the picture stands. Bitcoin is at $81,000 on a day when the United States Senate is preparing its most significant engagement with Bitcoin's legal future. Institutional money is moving out of gold and into digital assets in documented, measurable quantities. The Federal Reserve is not cutting rates, which means the pressure on American savings is not being relieved. The data shows real momentum and real risk, and neither has resolved itself. That is the complete and honest picture. The window between early and ordinary does not announce itself when it opens. It is only visible clearly once it is closed.